I think the most important number is that we'll see the unemployment rate fall a bit to 3.9%. So the job market is getting tighter, and that means we're continue to see stronger wage growth through the rest of 2018 into 2019.
What would be a disappointing number for you? What would be a number that would make you concerned that the Federal Reserve is going to have to put its foot on the gas pedal just a little bit harder?
Oh, I think if we saw, let's say, job growth of 250,000 or so, that would mean that the labor market is perhaps getting close to overheating. So I don't think we'll get there. But if we see excessive job growth from the Fed's perspective, then that could mean that they'd have to raise rates even more quickly.
You think they will?
No, I think we'll see an increase in September. Then I think they're probably going to hold off for the rest of 2018, and then we'll see a few increases in 2019. So, the Fed has said that monetary policy remains accommodative. Interest rates are a little bit lower than where they expect them to be over the longer run, but they have some room and they can afford to increase rates gradually. So we'll see the job market slow, but it's not going to be a dramatic slowing.
Yeah, listen, we had a guest yesterday, Danielle DiMartino Booth, who thought they would raise in September, December, and also January, that the statement we got a few days ago was so hawkish that they're basically telling the market, we're going to go up 3 times in the next 6 months. You think that's possible?
I don't think that that's likely. The Fed said the economy was strong. Obviously, we had very good GDP growth in the second quarter. That being said, I think we're going to see a little bit slower, still, around 3% in the second half of the year. So that's a good, solid number. That means that the economy is going to continue to improve, but that won't lead to those really strong wage pressures that will lead the Fed to tighten that aggressively.
Okay, what's wrong with the bond market then? I mean, why is the 10-year, it's like 3%. Is like the Maginot Line or something. I mean, we can't seem to get above that despite the Federal Reserve raising rates and telling us they're going to keep raising.
I think, for example, you had your earlier guest talking about oil prices and how they expect to go down, so that may put a brake on inflation. That being said, I do think that we'll see longer-term rates move a bit higher. I mean, obviously, you have bigger budget deficits, so that's going to raise borrowing costs. But on the other hand, you have the Bank of Japan, you have the European Central Bank continuing with their QE programs, so that's putting a little bit of downward pressure on the long end.
Okay, so then, as an economist, you look at this market and you say, things are good. The jobs number, if the jobs number misses a little bit, Gus, or beats it, doesn't really matter, right? We know the economy is absolutely on fire. The Fed is raising rates, but you got this whole tariff Trump trade thing hanging out. How do you model, given such a big wild card out there?
It's tough, and I think you have to say, look, I think the status quo is likely to prevail, that we may have a lot of noise but not much heat, and therefore we think that the global economy and the U.S. economy will continue to expand. But certainly you have to be prepared in case we do see big tariffs on Chinese-made goods. If we do see big tariffs on autos, then that's a huge downside risk. But I think the baseline is that things look very solid right now.